But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
Why do central banks hold it?
Well, it's a form of reserves.
Why don't they hold diamonds?
Well, it's tradition, long-term tradition.
Well, some people still think it's money.
Good evening. Welcome back to the most boring channel on YouTube, the Junius Maltby channel. Tonight, we're going to do some space travel. We're heading towards a vortex, a black hole of boredom. You might be wondering what that is. It's Fed speak. Whenever you discuss the Federal Reserve, it's boredom at a whole nother level. It's as if you took all of the boredom and were to compress it in a black hole, just as you would compress material and atomic particles to make the densest, heaviest boredom ever seen. And that is whenever you discuss, as we said, the Federal Reserve, because it doesn't get much more boring than that. And the Fed speak has to be translated by, of course, economic experts and people in the media and the news. First, let's take a look at these developing headlines that are in the news currently. Dow futures are slipping in wild overnight trading after the report that trade talks have stalled. We keep seeing in the news these mentions of the trade talks between the U.S. and China as they jockey back and forth to come up with some sort of a trade decision to see how we in America can buy cheap imported trash goods made by 5-year-olds in sweat factories for less money or less tariffs. And of course, China is wrestling with the President of the United States on these issues. Looking at gold prices, we're back in the $1,500 range at $1,514.20. Up $1.39 right now. And you can see that chart there dating all the way back into November of last year, where we were at those lows of around $1,200 an ounce. And it's still been climbing. You know, we've been talking about it. We've made videos on the rise that took place starting around June, and then again really kicking up again in August. These numbers we can expect to see even going higher. And once we get to the content later in this video regarding the Fed and just the indecision, the disagreement that's taking place there, I think it's really going to paint the picture of what might be coming down the road a little further. And of course, all of this is going to support gold's little brother, silver. Silver trading at $17.89 currently, up about 8 cents right now. And again, there's a chart of silver dating back into March of last year. You can see in the November lows there when it was below that $15 range. Silver has performed exceptionally well this year. We saw that spike all the way up to, if I recall, $19.54 there. And it has, of course, since retreated to where we see it currently. But it's been battling out and fighting to stay in that $18 range. I want to put up these two charts, one for gold, one for silver. Now, if you eliminated the name gold from this chart, and we've used this point before, and showed this to anybody, they would say, that is a good asset. What is that? I want a piece of that pie. And then if you told them it was gold, many would shy away from it. However, look at the performance here. Gold price, performance, percentage annual change in all of these currencies. If your currency's up there, whether you are Australian, Canadian, if you're on the euro or the British pound or the Japanese yen, take a look at these performance numbers. They're exceptional. Dating back all the way to 2004, we only can really see a few. And again, in the dollar, really had the roughest go. In 2013, we saw a 28% decline. 2014, 1.5% decline. 2015, 10% decline. That's really it. But the average in dollars was up in the green 9.6% from 2004 to 2019. The average 9.6%, 10% return. And again, you look at that 2004 to 2012 range, you're looking at 5%, 20%, 23%, 30% gain in 2007, 5.6% in 08, 2009, 23%, 29%, 2010. Just exceptional numbers. Then look at it, 2019, 17.8%, really making up for any of those years you see in red. You move on to some of the other currencies, you only have one or two down years. Look at it in Canadian dollars. In Canada, they've seen 9.4% every year. You're looking at nines across the board almost until you get to the euro. You got about a 10.7%, and you've got a 12.6% gain in the pound. And then the Japanese yen, you got 9.4. But really, in all of these currencies, you're seeing double-digit gains most of the time, averaging around 9%. And this just goes to show what's happening in those currency markets, what's happening with fiat globally. All the time, across the board, behind every border, we see these currencies losing value compared to gold. Gold rising in value in all currencies. Now here we have silver. Same chart, price performance, percentage annual change in all of those currencies from 2004 to 2019. It really got beat up in US dollars in 08, 2011, 2013, rough year. From 2013 to 15, brutal year for the silver stacking community. People are holding silver unless you were buying. It was a great time to be a buyer of silver. It had some great up years. In 2006, we had a 46.6% gain. Moving on, 2016 and 17, you had a 17%, a 7%. But it averaged. That's what you really want to look at here. Over that time span, 04 to 19, in US dollars, silver actually outperformed gold, which is surprising, by about 2%. It's up 11.1% over that same time span. And if you look at the average, let's just look at the average for all of these currencies. Again, you've got US dollars, you're at 11%, the Australian 10%, Canadian dollars 10%. You've got the Chinese yuan there, you got 10%, euro 12.2, pounds 13.4, yen 11%. So you're really seeing most of those numbers above the 10% mark. So silver, again, holding up, holding its own, really performing well in its price percentage gains against these currencies. Now, the reason I'm showing you these charts right now, the charts before the monthly and this last year's performance on both metals, and then these, greater than a decade performance charts, is because you have to keep this in mind to have that bigger view, that long-term view. If this is the performance we have seen, and we know what took place globally with the global economy over this time span with quantitative easing, the financial crisis of 07, 08, 09, obviously it spread into 2012. We've really never recovered or healed from it. It's almost like an economic armistice. It's just that pause between World War I and World War II, which a lot of people and historians will argue was the same war with a brief ceasefire. I believe that's what the economic catastrophe we saw in 08 was. It was just put on delay. It was, again, an economic armistice. It's going to occur. It's still occurring, and you're going to see that when we discuss recent Federal Reserve news that's coming out and some of the articles that are so exceptionally boring, I can guarantee you will go to sleep. We have the Ann cat here, the anti-government kitty. She pulled up a chair. She's purring. Apparently, this discussion entertains her enough to where she lets out her little purring voice, her little motor of happiness. So she's here. She'll join us. And Miss Maltby as well is sitting beside us. And we'll be reading some of these articles with myself. So let's take a look here at what the Federal Reserve has decided. The great ones, the little men behind the curtain that are working the machines, the fog and the light show, the smoke and the mirrors. Now, I knew the Fed was having a release of some information today that we're going to discuss, the meetings minutes. And it's always funny to me that they have to release the minutes. We can't see a recording, an audio, visual. And that's what I think it should be. If they really want to be open, let's be open. Let's record the whole dang thing and play it on C-SPAN. Let everybody see it. But instead, they give you the minutes. So here's just a highlight of some of the things we're going to talk about and cover. Market may be expecting more rate cuts than the Fed will deliver. Fed meeting minutes. What to know in markets Wednesday. Powell hints Fed is leaving the door open to another rate cut this month, citing global risk. The world, according to the Federal Reserve, Jerome Powell. And you can see he's wearing rose-colored glasses there. And don't worry, we'll show you that image again. Some of you may remember the old saying, if you have 3 economists in a room and you ask for their opinion, you'll get 5 or 6 different answers, 5 or 6 different opinions. That's because none of them can agree or decide on anything. And we've talked about the hocus-pocus science and education model behind economics, the history of it, how the Fed really funded all of the first economic schools in the United States to indoctrinate and teach and spread their propaganda. And that's where most modern economics comes from and the education surrounding it. Gold prices unmoved. CPI in focus as minutes confirm a divided Fed. Of course they are divided. Gold prices were effectively unchanged this afternoon in the wake of the latest release of discussion minutes from the Federal Reserve. The minutes and notes confirmed the market's general assessment of a very divided Fed with regards to the rate path forward. Gold spot prices have closed Wednesday's trading at $15.05.40 an ounce, while silver prices closed just above $17.70. And since I've probably bored you all to death, as Miss Maltby has said, we'll let her read this portion of the article.
Notes on the Federal Open Market Committee's discussion, which resulted in a second consecutive 0.25% cut to short-term interest rates in September, established 3 distinct camps within the Fed. Those who felt that there is more easing needed to fend off a nearing recession, those who supported September's cut but now believe the committee should hold rates steady, and those who believed even a second quarter point of easing was too aggressive in light of decent data on the U.S. labor market and inflation. My 3 biggest takeaways from the minutes are as follows. 1. Several committee members mentioned that their models were showing a marked increase in the odds of a recession hitting the U.S. economy in the medium term. 2. The committee as a whole seems to still believe that the key drivers of that recession threat are still outside of the routine mechanics of the U.S. economy, that is, geopolitical risk, economic weakness outside the U.S., and, of course, trade tensions. 3. Surprisingly, there were some mentions of concerns over inflation, not at present, but longer term, convincing some members to support September's cut.
Further articles discussing this, market may be expecting more rate cuts than the Fed will deliver, meeting minutes show.
The Fed released minutes from its September meeting where the central bank approved a 0.25-point rate cut. Fed minutes show that, quote, a few participants at the September meeting said prices in future markets were currently suggesting greater provision of accommodation at coming meetings than they saw as appropriate. It might become necessary for the committee to seek a better alignment of market expectations regarding the policy rate path with policymakers' own expectations for that path, the minutes also said. Minutes showed that trade was the overriding concern. The issue garnered 28 mentions in the document, with members repeatedly expressing concerns about the impact tariffs were having on business activity.
Members saw increased downside risks to the economy. It's always impressive how the Fed can use statements like increased downside risk to downplay what is truly the observation of anyone who's looking at this objectively, that there is downside risk not only in the future, but currently occurring. There is risks that are not even risks any longer. There is damage being done. Some Federal Reserve policymakers expressed concern at their most recent meeting that markets are expecting more rate cuts than the central bank intends to deliver, according to minutes released Wednesday. The FOMC approved a 0.25-point rate cut, as we've discussed, at the September 17th to 18th meeting, putting the overnight funds rate in a target range of 1.75 to 2%. but documents released after the meeting also showed sharp divisions among members about the future path of policy. Minutes amplified those concerns, along with some worry that a market clamoring for easier monetary policy might be getting ahead of itself. The summary said that, quote, a few participants at the September meeting said prices in futures markets were currently suggesting greater provision of accommodation at coming meetings than they saw as appropriate. And this is when I believe the big banks and Wall Street and those that have the money, those that have the power, are trying to manipulate Fed decisions. Even though you and I would agree we don't believe the Fed should even exist to make these decisions, they are trying to be influenced by outside sources and those with the big bags of coin over there on Wall Street. I'm going to inject this one little plug here because I watched an interesting video by the Kaiser Report yesterday, Max Kaiser and his wife Stacy Hebert, and he was talking about the velocity of money being at an all-time low. And then the headline for this broadcast of his was, U.S. must accumulate more and more debt in order to keep economy from collapsing. And that indeed is true. But a key takeaway from that was the velocity of money being at an all-time low. And we're in a system now where the Treasury and the banks are working as a cartel, as a cabal, just giving each other money, lending money, issuing money, and all of the money that's getting stuck in this vortex going around in a circle from the Treasury to these banks is being stuffed up, and the profits are going to the elite, to the wealthy, and it's really not flowing into the system like it should be through the economy. The economy is broken. The world economy is indeed at this time broken. Back to the main article here. Because of the potential misunderstanding, it might become necessary for the committee to seek a better alignment of market expectations regarding the policy rate path with policymakers' own expectations for that path, the minute said. Again, this is Fed speak, so you have to kind of like try to translate it out of their language. And to me, it reads as if the Fed is going to try to align its policies and come into some form of agreement with, quote, market expectations regarding their policies. And it just seems to me as if there's some type of a collusion going on between the Fed's decisions and what the banks expect and want that decision to be. Remember, I warned you this was going to get dry. It was going to be boring. Here's what they left out of the statement. In addition, the minutes noted that several participants thought the committee, in its post-meeting statement, should provide some guidance as to how long the Fed would remain accommodative due to concerns over tariffs. The final statement did not include that type of language. The dot plot of member expectations released at the meeting showed that 5 members favored the Fed not approving any additional cuts this year after the most recent move, 5 more seeing an increase ahead, and 7 wanting an additional cut. Think of that. 7 of the members of the Fed wanted further rate cuts. The final tally among the 10 voting members saw 3 dissents from Fed Presidents Eric Rosengren of Boston and Esther George of Kansas City, who favored holding the line, and James Bullard of St. Louis, who wanted a half-point cut. That marked the most dissenters since December 2014. In justifying the cut, Fed officials cited concerns over slowing global growth spilling into the U.S., the ramifications from the U.S.-China trade war, and persistently low inflation that had been running below the Fed's 2% target. I always think it's hilarious when they talk about inflation being too low. It's laughable. This part was entertaining. In addition, softness in business investment and manufacturing so far this year was seen as pointing to the possibility of a more substantial slowing in economic growth than the staff projected. We need to hear that part again. More substantial slowing in economic growth than the staff projected. The risks to the inflation projection were also viewed as having a downward skew, in part because of the downside risks to the forecast for economic activity, the summary continued. Officials also noted that a clearer picture of protracted weakness in investment spending, manufacturing production, and exports had emerged, and members also were watching the yield curve inversion, a reliable indicator that a recession is ahead. These are some staggering words to see coming out of the diagnosis of Fed minutes. Still, members noted current conditions remain strong, with robust consumption and an employment picture that continued to improve. Now remember, just before the last economic catastrophe of 07-08, they were saying very positive, very rose-colored things. Just like that, robust consumption, an employment picture that continued to improve. Remember, the housing market was strong and not showing any signs of weakness. Remember all those positive things. And you can go back and just watch the recap of the timeline that we discussed on the statements being issued back then. And that was in a video, last month. It's somewhere in the playlist. You could find it. Those who favored holding the line worried about financial stability risks that low interest rates posed. Others also stated concern that cutting rates now would leave the Fed little wiggle room the next time a slowdown emerged. And that is true. The funny thing is, these are the big experts. These are the head honchos, and they can't even figure out what to do. It's like having 4 captains on a ship that just struck an iceberg, and one of them wants to go faster, one of them wants to slow down, and one wants to go left, the other wants to go right. Nobody knows what to do. No one can agree on it. It just goes to show there is something amiss. The repo discussion. Fed officials also discussed the recent upset in overnight lending markets that resulted in a spike in short-term rates. The central bank addressed the issue with several temporary liquidity actions aimed at stabilizing the market. Members said future discussions about the proper size of bank reserves would be appropriate. In a speech Tuesday, Fed Chairman Jerome Powell said the central bank likely will start repurchasing Treasury bills as part of a move to grow the balance sheet and reserves. Members also suggested looking into a standing repo facility to address funding issues. The minutes stressed, as did Powell, the importance of distinguishing that type of balance sheet growth from the quantitative easing programs the Fed used during and after the financial crisis. Powell hints Fed is leaving door open to another rate cut this month, citing global risks. We all know what further rate cuts means. Easy money, easy credit, further expansion and blowing up of the bailout bubble, the bubble as a whole, and of course, all of this easy money, increasing the money supply, will in turn impact gold and silver prices in a positive trajectory. Federal Reserve Chairman Jerome Powell hinted Tuesday that the central bank is leaving the door open to another rate cut later this month, saying global growth has slowed and uncertainties around trade, Brexit, and other issues pose risk to the outlook. In prepared remarks he's scheduled to deliver in Denver, Powell suggested Fed policymakers have not made a decision, noting the next Fed meeting is several weeks away and we will be carefully monitoring incoming information. Policymakers, he added, will be data dependent and assessing the outlook on a meeting-by-meeting basis. But at the National Association for Business Economics annual meeting, he plans to add pointedly, taking all that into account, we will act as appropriate to support continued growth, a strong job market, and inflation moving back to our symmetric 2% objective. This could be the most important sentence of the entire discussion. While the economy is still on solid footing, Fed officials have said they want to stave off a possible recession by next year. That's almost like getting on a plane and the pilot looking at you and saying, I'm hoping not to crash when we land this time. Now here is Mr. Powell with his rose-colored glasses who believes the economy looks good. What's happening? It's becoming clear to more economists and market participants that the Fed's toolkit is losing its effectiveness and monetary policy may be powerless to protect the economy if there's a recession. So Powell has deployed a central bank's most consistent weapon, communication, aka propaganda. What is he saying about the unprecedented level of U.S. debt? Quote, households are in good shape, businesses are borrowing a lot, and it's something we're monitoring carefully. But again, the vulnerabilities are moderate. Businesses borrowing a lot means they're going into debt, my friend. Number 2, about the possibility the Fed's loose monetary policy could overheat the economy. This just feels very sustainable. There's no aspect of the economy that is booming. You've got a solid consumer sector where wages are going up at the level of productivity plus inflation. Job creation is healthy. There's no one sector like a housing bubble. There's nothing like that, unquote. 3, about the growing worry from investors and the business community. There are concerns about business investment in manufacturing and trade, of course. We don't get to see the 11th year of an expansion a lot, and there's a lot to like about it, particularly for people at the lower end of the wage scale who are getting now the highest raises, and it'd be great to continue. About why the Fed is cutting interest rates. I look at this akin to the 2 instances in the 1990s when the Fed cut and then cut again and cut a 3rd time. It provided some support for the economy, and the economy took that accommodation on board and gathered steam again, and the expansion continued. That's the spirit in which we're doing this. He might not remember that after that we had the dot-com bubble burst in the late 90s. So that might not be the best point to make there, tough guy. About the Fed injecting around $300 billion of cash to buy U.S. Treasuries in the repo market and plans to continue indefinitely, isn't that quantitative easing? Quote, this is not QE. In no sense is this QE. This is nothing like it at all. With no further explanation. He knows exactly what it is. I mean, it's hilarious, my friends. It's hilarious how these guys answer these types of questions. 6, Fed chairs have typically worried about inflation getting too high, but Powell confirmed on Tuesday that he is instead focused on keeping inflation from getting too low. Quote, it feels like the problem of this era is to keep inflation from moving down and try to keep it at 2%. We want inflation expectations centered right at 2%, and we really want to hammer that point and make sure that they are, because we look around the world and we see disinflationary forces. State of play, with consumer confidence falling, leading economic indicators turning negative, systemically important repo market in disrepair, major European economies likely in recession, the outlook for the trade war deteriorating, and stock market volatility popping, Powell is doing his best to infuse confidence into the market via his propaganda, which isn't working. Go deeper. The unusual new leaders of our unusual new world. The minutes showed that among the options discussed would be to allow the Fed's balance sheet to grow again. The Fed had been reducing its holdings that had surged to a peak of $4.5 trillion in the wake of the Great Recession as it engaged in several rounds of bond purchases aimed at lowering long-term rates and giving the economy a boost. Those bond purchases were known as quantitative easing. Powell said that while various options were being weighed for providing more stability for the short-term funding markets, the effort should not be considered a new round of quantitative easing. Now, in other obscure Fed news that came out earlier this week, Fed and other regulators approved changes to Volcker Rule to ease bank restrictions. Brainerd dissents, saying changes weaken core protections put in place after the financial crisis. The Federal Reserve and 4 other regulatory agencies announced final approval Tuesday to changes in the Volcker Rule passed after the 2008 financial meltdown to crack down on trading excess that contributed to the crisis. So why would you get rid of it then? The changes were supported by the banking industry, which felt that the original rule seeking to prevent banks from speculative trading with government-insured deposits was too restrictive. But they were opposed by Wall Street watchdog groups and the rule's namesake, former Fed Chairman Paul Volcker. Fed board member Lael Brainerd issued a rare dissent to the final rule. She said it weakens the core protections against speculative trading within the banking federal safety net. The 5 agencies said the new rule would take effect on January 1, with banks given a year to comply. The liberalized rule would continue to prohibit banks from engaging in proprietary trading or investing in or sponsoring hedge funds or private equity funds. It also provides a greater clarity for activities that will still be allowed under the law. In her dissent, Brainerd said that she was concerned that the new rule would significantly reduce the scope of investment activity that would be prohibited and would rely too much on the banks to self-police their own conduct. President Donald Trump has been a vocal critic of the Dodd-Frank Act, the law passed after the financial crisis to reorganize the banking system, and that includes the Volcker Rule. He has said it was too restrictive on banking activities and has made loosening the regulations imposed on banks a big part of his deregulation effort since taking office. In a letter to Fed Chairman Jerome Powell in August, Volcker, 92, said that the proposed rule went far beyond simplification. Quote, "The new rule amplifies risk in the financial system, increases moral hazard, and erodes protections against conflicts of interest that were so glaringly on display during the last crisis," unquote, Volcker wrote. In addition to the Federal Reserve, the other agencies announcing adoption of the new rule on Tuesday were the Federal Deposit Insurance Corporation, the Commodity Futures Trading Commission, the Office of the Comptroller of the Currency, and the Securities and Exchange Commission. I think it's clear that all this points to potential weakening, further weakening, uncertainty, disagreement at the highest levels of the controls of the global economy. And all of this can only lead to one thing: a deterioration of the strength of all currencies, especially and specifically the US dollar. I've seen writings now that point to a floor of gold around 1,300. You've heard me say it was around 11 or 1,200, 1150. We're now seeing people call for a bottom, the baseline, if you will, for gold at around 1,300, a continuing case for a weakening U.S. dollar over time, and just more and more information pointing to increased government debt, increased economic turmoil, all of this resulting in metals prices on a continued rise from where we've seen and where they've been. I think the case for gold and silver both is very strong. The uncertainty at the Fed should just shake anyone who reads it or looks at it to the core, and if anything, sober them up to realize things are not what they seem. Even the Fed is letting permeate in their minutes a negative outlook for the world and global economy. It's clear they're doing all that they can to kind of keep people at ease and not raise the alarm bells and not cause panic. But I think you can see enough information leak out in just these little minutes, which is what they allow us to see and hear. And you can only wonder, what do they not tell us? What doesn't get into the minutes? So there you have it. That's today's 33-minute broadcast here on the Junius Maltby channel. If you've stuck around for the whole thing, good for you. Many of you, I'm sure, are asleep or have logged off by now. I know many of you can only stick around for about 10 or 12 minutes, and that's fine. I understand that completely. Who's got 30 minutes to sit around and listen to this garbage? Well, if you did, good for you. Keep stacking. If you like the channel, you like this content, hit that thumbs up, that like button for me. Throw a comment down below, join the discussion. If you want to support the channel, there's all kinds of ways to do that. You can support it just as some people do through simple little tiny donations, or just go to the Teespring store and get some very boring attire. Get yourself a sweatshirt, a t-shirt, a coffee mug, or a sticker. Yes, we have Junius Maltby stickers now. So if you have the round, the ultimate round of freedom and liberty of precious metals, the Maltby round, well, you should probably have one of the stickers too. Slap that on the back of your car so if I see you in traffic, I can give you a thumbs up. All right. Take care, my friends. Thanks for tuning in and being part of the channel. Have a good night.